If you've got even a single ounce of silver tucked away in your safe, or if you're eyeing investments in copper, rare earth metals, or any of the critical minerals that power our modern world, you need to drop everything and listen up. Right now, in early February 2026, the United States government has just pulled off something that sounds like it came straight out of a high-stakes economic thriller. Vice President J.D. Vance stood before representatives from over 50 nations. Actually, the count hit 55 at the Critical Minerals Ministerial Summit in Washington, and essentially declared war on the free-fall pricing that has plagued these essential resources. They're not just talking about it, they're proposing a coordinated system of price floors, minimum thresholds below which these minerals can't drop, enforced through tariffs, subsidies, and collective action. This isn't some minor policy tweak. It's a seismic shift that could redefine global trade, national security, and your portfolio's future. Let's start by unpacking what this really means, because the headlines might make it sound like a simple bailout for miners, but it's so much more. A price floor is basically a government-backed guarantee. If the market price of, say, silver or copper dips too low due to oversupply, dumping, or economic slumps, the coalition steps in to prop it up. How? Through a mix of tools tailored to keep supply flowing without bankrupting producers. Direct purchases, where governments act as buyers of last resort, snapping up excess stock at the floor price to maintain stability. Adjustable tariffs that slap extra costs on cheap imports from non-members, making sure no one undercuts the system. And subsidies that bridge the gap if market rates fall short, ensuring miners and refiners can cover costs and stay operational. This isn't about manipulating prices for profit. It's about survival in a world where these minerals are no longer commodities. They're weapons in a geopolitical arsenal. Why the urgency? Because we're staring down the barrel of an unprecedented demand explosion. Think about the electrification of America and the world. We're building out massive data centers for AI, facilities that suck down more electricity than small cities, all wired with miles of copper cabling. The push for electric vehicles is ramping up. By 2030, projections show tens of millions more EVs on U.S. roads, each one demanding pounds of copper for batteries, motors, and charging infrastructure. Our electrical grid, much of it dating back decades, needs a complete overhaul to handle renewable integration. Solar farms, wind turbines, all reliant on silver for photovoltaic cells and rare earths for high-efficiency magnets. And don't forget defense. Hypersonic missiles, drones, advanced radar systems, they all crave these materials. If prices crash, mines shut down, refineries mothball, and suddenly we're when we need them most. This coalition, spanning allies like Japan, Germany, Australia, India, South Korea, and emerging producers like Argentina and Peru, is saying enough is enough. They're drawing a line in the sand to prevent that nightmare. Silver, in particular, stands out as a prime beneficiary here. It's not just the shiny stuff in jewelry or coins, it's a critical industrial metal. Over 50% of silver demand comes from electronics, where its unmatched conductivity makes it irreplaceable in circuit boards, switches, and sensors. Solar panels gobble up massive amounts. Each panel uses about 20 grams, and with the US aiming for net zero emissions, we're talking billions of grams in the pipeline. Medical devices, water purification, even antimicrobial coatings in hospitals rely on it. But silver mining is often a byproduct of other operations like copper or lead. So when those prices tank, silver output dries up too. A price floor changes that dynamic. It incentivizes dedicated silver projects, keeps marginal mines open, and signals to investors that the downside is limited. If the floor holds, silver could see sustained upward pressure as demand outstrips supply, especially if geopolitical tensions flare and investors flock to it as a hedge. Copper's story is even more compelling. Known as Dr. Copper for its ability to diagnose economic health, this metal is the lifeblood of infrastructure. From power lines to plumbing, EVs to renewable grids, copper's conductivity and durability make it indispensable. The U.S. alone faces a projected shortfall of millions of tons by 2035 if new mines don't come online. But developing a copper mine isn't like flipping a switch. It takes 10 to 15 years from exploration to production, billions in capital, and navigating a maze of environmental regulations. Low prices in the past have killed projects midstream. Think of the Resolution copper mine in Arizona, stalled for years amid permitting battles. With this international push for floors, expect a rush of investment into friendly jurisdictions. Countries like Chile and Peru, already major producers, are signing on, which could stabilize global supply while shifting it away from riskier sources. Rare earth elements, things like neodymium, dysprosium, and praseodymium, might sound esoteric, but they're the unsung heroes of high-tech. These 17 metals enable the powerful magnets in EV motors, wind turbines, and military gear like fighter jets and submarines. Without them, your smartphone's vibration motor or hard drive wouldn't work. The problem? China controls about 80% of global refining capacity, giving them veto power over supply. Remember the 2010 rare earth crisis when China cut exports to Japan over a territorial dispute? Prices spiked 500 to 1,000%, crippling industries. This coalition aims to break that stranglehold by fostering Western refining hubs, perhaps in Australia or Canada, backed by price guarantees to make the economics work. It's a long game, but the payoff could be immense. Reduced vulnerability, job creation in allied nations, and a more balanced global market. Now, let's talk about the elephant in the room: China. This entire initiative is framed as a direct response to Beijing's dominance. For 4 decades, the West chased cheap labor and lax regulations, outsourcing the messy middle of supply chains: refining. Digging ore is straightforward: blast, haul, crush. But turning it into usable forms involves harsh chemicals, toxic waste, and environmental headaches. China invested heavily, building ecosystems of factories, chemists, and infrastructure. They now refine 60 to 90% of key minerals, depending on the type. This gives them leverage. They can restrict exports during tensions, as seen with gallium and germanium curbs in 2023 amid U.S. chip restrictions, or flood markets to crush competitors. The U.S. and allies are waking up, but rebuilding isn't easy. In democracies, new refineries face NIMBY opposition. Nobody wants a chemical plant near their backyard. Permits drag on. Lawsuits from environmental groups can add years. The price floor is essentially a bribe. Promise stable returns to lure capital and endure the pain. But China's not sitting idle. They're pushing their own agenda, including efforts to internationalize the yuan and challenge dollar hegemony. Reports from the summit highlighted concerns over China's gold hoarding, central bank purchases hitting records, as a potential backstop for a yuan-based system. Gold isn't just bling, it's a trust anchor, immune to default or inflation. If countries diversify reserves away from dollars, it could mean higher U.S. borrowing costs, feeding into inflation. Yet the dollar's dominance is sticky: deep markets, legal protections, global acceptance. A full shift would require trust in alternatives, and many nations hesitate to bet big on the yuan given China's capital controls and opacity. This mineral push ties into currency dynamics because supply chains dictate payment flows. If the West builds its own bloc, trades in dollars or euros, it reinforces existing systems. But fragmentation, regional deals, bilateral swaps, could erode the dollar's share from 60% of reserves to lower, not overnight collapse, but a gradual squeeze. For Americans, that means potential for sticky inflation. Higher mineral costs ripple into goods, from cars to gadgets. Your grocery bill might not skyrocket, but expect incremental creeps in energy, transport, and tech prices. Skeptics argue this is all theater. Grand announcements with little follow-through. Trade blocs sound great, but enforcing floors across 55 nations? Cheaters will relabel shipments, route through proxies, or exploit loopholes. Bureaucracy could bog it down. Think WTO disputes or internal squabbles over floor levels. What if prices get too high? Manufacturers might offshore to access cheaper Chinese supply, undermining the goal. And environmental costs. Ramping mining in the West means more scrutiny on water use, habitat disruption, indigenous rights. Projects like Alaska's Pebble Mine highlight the tensions: rich deposits but fierce opposition. Yet the momentum is real. The U.S. has inked deals with 11 new partners, building on the Minerals Security Partnership, MSP, from 2022, now expanded. Legislation like the Inflation Reduction Act funnels billions into domestic processing tax credits. Private sector's jumping in. Companies like Rio Tinto and BHP are eyeing joint ventures in safe havens. For silver specifically, industrial demand is forecasted to hit 1.2 billion ounces by 2030, up 20% from now, while mine supply lags. A floor could bridge that gap, preventing the boom-bust cycles that deter investment. Copper's outlook is bullish too. Global demand could double by 2050 per some estimates, driven by net zero goals. U.S. initiatives like the CHIPS Act indirectly boost it via semiconductor fabs needing robust power infrastructure. Rare earths? The Department of Defense is stockpiling, and new separation tech from firms like MP Materials in California promises cleaner processing. Investors, this is your cue. Volatility ahead, but opportunities abound. Quality miners in coalition countries, think Freeport-McMoRan for copper or Silver Wheaton for precious metals, could thrive. ETFs like the Global X Copper Miners or Sprott Physical Silver Trust Offer exposure without picking stocks. But diversify. Don't go all in on metals. Balance with bonds, tech resilient to inflation, or even farmland as a hard asset hedge. Geology's the ultimate arbiter. Deposits are finite. Grades decline, meaning more energy for less output. Governments can't print silver or copper. This coalition admits scarcity, signaling prices won't stay cheap. For the USA, it's about reclaiming control, bolstering security, and fueling innovation. Stay vigilant. Watch for actual implementations, not just talks. This could be the start of a new economic era where resilience trumps cost, and your investments need to adapt accordingly. Expanding on the implications for everyday Americans, consider how this ripples through the economy. Higher stable mineral prices mean pricier EVs, perhaps adding $500 to $1,000 to the sticker, slowing adoption but ensuring long-term supply. Home solar installations could cost more upfront, but subsidies might offset. Defense spending, already ballooning, gets a boost as secure domestic chains reduce risks. Jobs? Expect thousands in mining towns from Montana to Nevada, refining hubs in Texas or Louisiana. But challenges. Rural communities might resist environmental impacts, leading to political divides. Globally, this could reshape alliances. India, with vast untapped reserves, becomes a key partner, diversifying from China. Africa, nations like the DRC for cobalt, Zambia for copper, sees investment influx but with strings for ethical mining. Europe, via the EU's Critical Raw Materials Act, aligns closely, harmonizing standards. Currency-wise, gold's role amplifies. Central banks bought 1,000+ tons in 2025. If dollar wobbles, more follow. Silver, as gold's poor cousin, often moves in tandem but with higher beta, bigger swings. A floor limits crashes, amplifying upsides. Risks abound. If the block fragments, prices plummet. Trade wars escalate if China retaliates with export bans. Inflation persists if costs aren't absorbed. Yet, optimism. Technological breakthroughs like bioleaching or recycling could ease pressures. U.S. innovation, think startups in advanced materials, turns threats into edges. In sum, this isn't doom, it's adaptation. Position wisely, stay informed, and thrive in the new normal.